Hello students, in present video I am going to explain about fifth problem from company accounts topic. I am taking this question from advanced accountancy subject BCom second year semester 3 publications Pankaj publications. Previous videos links are available in the description box. Let us see the question first. See, this is the fifth question. Amar Limited issued 5,000 equity shares of 10 rupees each at a premium of 2 rupees per share payable 2 rupees on application, 5 rupees on allotment including premium, 3 rupees on first call and the balance on final call. The call on 1000 shares, there is a printing mistake here. It should be the first call on 1000 shares and the final call on 1500 shares was not received. Give cash book and journal entries for the above transactions. Also prepare its opening balance sheet. This is the question. Let us see the solution for this. Let us understand the question first. There is one public limited company, Amar Limited. So their authorized capital is not given in the question. Issued capital, company wants 50,000 rupees capital. For that, company wants to sell shares to public. Company issued 5,000 shares at the rate of 10 rupees each. So here this 10 rupees known as face value of the share or par value of the share. So issued capital is 5,000 into 10 rupees each, 50,000. Public applied for 5,000 shares and the company allotted all shares. Means subscribed capital is also same, 50,000 rupees. Then called up capital. One share face value is 10 rupees now. How company wants to collect this money? On installment basis. 4 installments. Application, allotment, first call, final call. While applying for shares, public have to pay 2 rupees per share. So application money is 2 rupees per share. And company wants to sell the shares at a premium. Premium amount is 2 rupees. Company wants to collect this premium money with allotment money. On one share, company wants to collect 5 rupees through allotment. So in this 5 rupee, 2 rupees premium. Then remaining amount 3 rupees actual allotment money. Next, first call money per share 3 rupees. Then final call amount is not given directly in the question. He is giving that remaining amount company wants to collect through final call. How much is the remaining amount? One share face value is 10 rupees now. In this 10 rupee, application money 2 rupee, allotment money 3 rupee, first call money 3 rupee. So total 8 rupees. 10 rupee minus 8 rupee, remaining amount is 2 rupees. So final call amount is 2 rupees per share. Premium is a new point in this problem now. I will explain about premium later. 10 rupee per share into subscribed capital is 5,000 shares now. Therefore, called up capital is 5,000 into 10 rupees, 50,000. So in current year, company made all calls. Therefore, called up capital, subscribed capital, both are same, 50,000. Finally, paid up capital. So called up capital is 50,000 now. Company should receive 50,000 rupees from shareholders. On 1,000 shares, company failed to collect first call money. On 1,500 shares, company failed to collect final call money. On one share, first call is 3 rupee. On one share, final call is 2 rupees. Therefore, 1,000 into 3 rupee, 3,000. 1,500 into 2 rupees, 3,000. Total 6,000 is not going to come from public. So this 6,000 is lost to company and known as calls in arrears. So from called up capital, when we subtract calls in arrear, then the remaining amount 44,000 is paid up capital. Now come to new point, premium. Let us know some important points about share premium. One share face value is 10 rupees now. There is no rule that company should issue the shares at face value only. Company may issue the shares at par or at a discount or at premium. Suppose company wants to sell the shares for 10 rupees. We can say that issue price is also 10 rupees. Company wants to sell the shares for 8 rupees. So face value is 10 but issue price is 8 rupees. This is called issuing the shares at a discount. In present problem, company wants to sell the shares at 12 rupees. Because application money 2 rupees. Through allotment, company is going to collect 5 rupees, no? First call 3, final call 2. 2 plus 5 plus 3 plus 2. Total 12 rupees. So issue price is 12 rupees, but face value is 10 rupees. Issue price is more than face value. This is known as issuing the shares at a premium. And the premium amount is issue price 12 rupees minus face value 10 rupees is equal to 2 rupees per share. Financially strong and well managed companies, generally they issue the shares at a premium. Company may collect this premium money on equity shares or on preference shares. In present problem, company is collecting 2 rupees per share as a premium now. Issued shares are 5,000. So total premium amount is 5,000 shares into 2 rupees per share, 10,000 rupees. With allotment money, company is collecting this 10,000. Means as a lump sum they are collecting. Sometimes company may collect this premium money 10,000 on installment basis also. And generally premium will be collected with allotment money, rarely with call amounts. So collecting premium money with application is rare. Because with application, if company collects premium money, it leads to complicated calculations. Because in case of oversubscription, company may refuse to allot the shares to some applicants. Then they paid application money to company, no? That application money company should return to them. If premium is collected with application money, while returning the application money to applicants, even premium calculations also we have to do. To avoid the difficulty in calculations, generally company doesn't collect premium money with application amount. In present problem, he is asking us to prepare cash book, journal and opening balance sheet. First cash book we prepare. So it is one subsidiary book. Subsidiary books are total 8 now. Purchase book, sales book, purchase returns book, sales returns book, cash book, bills receivable book, bills payable book, journal proper. So company is maintaining one subsidiary book, that is cash book. In case of other subsidiary books, for example purchase book, sales book, we prepare purchase book and purchase account, sales book and sales account. Means journal is separate, ledger is separate. But cash book is a peculiar book. In case of cash book, even though we call it as cash book, cash journal, format is ledger format only. Because when transactions take place, first time we record in cash book and that is a final. Means again from cash book we are not going to post the transaction anywhere in the ledger account. So cash book acts as a book of primary entry and secondary entry. That is why even though we wrote cash book word, format is ledger account format only. Ledger format, date, particulars, JF number, amount. Credit side also same. To indicate that this is an account, left side DR symbol, right side CR symbol we have to write. So all cash transactions, cash receipts and cash payments we should record in this cash book. To record transactions in cash book, there are two methods. First one, for every cash related transaction, there will be one journal entry, that journal entry we have to post in cash book. Second method is cash book. In this book, we are going to write about cash. So cash is an asset. Asset comes under real account. Real account rule, debit what comes in, credit what goes out. So to the company, if cash is coming, that should be debited in cash book. Means cash receipts we have to debit. From the company, if cash is going, we should credit in cash book. Means cash payments we have to show on credit side of cash book. So any one method you can follow. So first what happened? Company is receiving application money. How much? Subscribed capital is 5,000 shares now. On one share application money is 2 rupees. So 5,000 shares into 2 rupees each, 10,000 company is receiving. What is the journal entry for this? Bank account data to share application account. So bank account is debited. Bank account, cash account, both are same only, no difference. So when bank account is debited, that entry in cash book debit side we should post. Thus, think the journal entry and post that entry in cash book. First method. Second method, application money is coming to the company. This is cash receipt. So cash receipts on debit side we have to show now. Therefore, this 10,000 directly on debit side we can write. In particulars, what to write? To share application account. On 5,000 shares at the rate of 2 rupees each, 10,000 rupee is coming through application amount. Next, allotment money. On one share, allotment money is 5 rupees. No? This 5 rupee includes 2 rupees premium also. Through allotment, how much money company is collecting? 5,000 shares into on one share 5 rupee. 5,000 into 5, 25,000 rupee company is collecting. So 25,000 rupees cash receipt, no? Debit side we should show. In particulars, to share allotment account. How 25,000 is coming? On 5,000 shares at the rate of 5 rupees each, 25,000 company is collecting. Next come to first call. First call money should come on 5,000 shares. On one share, first call amount is 3 rupees. No? 5,000 into 3, 15,000 should come. But on 1,000 shares, first call amount is not coming. So call scenario is there. 1,000 into 3 rupees per share, 3,000 is call scenario. Then finally how much money came? 12,000. That 12,000 write in amount column. To share first call account. Show this information clearly here. On 5,000 shares at the rate of 3 rupees each, 15,000 should come. But on 1,000 shares, first call amount is not coming. 3,000 is not coming. Then the remaining amount 12,000 in outer column. Next come to final call. On 5,000 shares at the rate of 2 rupees each, 10,000 should come. And on 1,500 shares, final call money not came. So 15,000 into 2 rupee, 3,000 is the call scenario here. Finally, how much amount is coming? 7,000. 7,000 in amount column. In particulars column, to share final call account. Show this calculation here. On 5,000 shares at the rate of 2 rupees each, 10,000 should come. But on 1,500 shares, final call money is not coming. 3,000 is call scenario. Then finally 7,000 rupees came. That 7,000 in outer column. Finally find out the balance. Debit side total is 54,000. So in this 54,000, 44,000 is a paid up capital and the 10,000 extra is what? Share premium. So credit side total is less, no? Therefore credit side show that balance amount 54,000. For that, in particulars column, by balance carried down. Two sides write down the total. Take a screenshot of cash book. Cash book is completed. Now let us write the journal entries for non-cash transactions. Once you recollect previous problems, for all transactions, we used to write journal entries in journal. But in present problem, company is preparing cash book separately. Then in cash book, cash transactions we have to record, cash receipts and cash payments. And in journal, remaining transactions, non-cash transactions, only we should show. Why? Recollect subsidiary books lesson. For example, purchase book you take. Purchased goods from Ramana. Suppose subsidiary books are not maintained. Purchase book is not maintained. Then where we record the journal entry for this? In journal book. Entry, purchase account to Ramana account. If purchase book is separately maintained, in journal we don't write a journal entry. Directly that a purchase transaction in purchase book we record. So when subsidiary book is maintained, directly the transactions are recorded in subsidiary books. Therefore, the transaction related journal entry we should not show in journal. Here also same. If cash book is not maintained, suppose application money 10,000 is coming now. In journal book, we have to write a journal entry for that. Bank account data to share application account. When cash book is maintained, there is a 10,000 directly in cash book we are showing. Therefore, that entry bank account data application account in journal we should not record. If you record in journal also, then it leads to duplication of work. So there is a chance of posting this entry again in cash book. Already in cash book share application money 10,000 is posted now. Again we should not post. That is why application received entry, allotment received entry, first call received entry, final call received entry, we should not write in journal. Then what are left? Transfer entries. So application money we should transfer to share capital account. Similarly, allotment money, first call money, final call money we transfer to share capital account now. So these transactions are known as non-cash transactions. So these transaction related entries only we have to show in journal book. First is for application. Application money we want to transfer to share capital. So share capital is a liability. Liability shows a credit balance. Therefore, we should credit share capital account. And which account is to be debited? Once you recollect application received entry, bank account data to share application account. So here share application account is created. We are writing that from applicants we are receiving share application money. To us share applicants are creditors. Now that creditors account we are transferring to share capital now. After that applicants are not creditors. Means creditor account we should cancel. By crediting we have created share application account. If you want to cancel you have to debit that. We should debit share application account. This is the first entry. Amount 5,000 shares into 2 rupees each, 10,000. See, this is a journal. Format, serial number, particulars, debit, credit. First entry, share application account data to share capital account. Narration, 5,000 shares at the rate of 2 rupees each, 10,000 we are transferring from share application account data to share capital account. Write that. Being share application money on 5,000 shares at 2 rupees per share is transferred to share capital account. Second entry is for transferring allotment amount to share capital. Share capital should be created to share capital account. 5,000 shares into how much we should transfer? Carefully observe here. Through allotment, company is collecting 5 rupees per share. In this 5 rupee, 2 rupee is premium now. So premium amount separately we should show. To share capital, only the actual allotment money we should transfer. Actual allotment money is 3 rupees per share. 3 rupees into 5,000 shares, 15,000. So to share capital, 15,000 only we should transfer. But from applicants, how much money should come? 5 rupee into 5,000, 25,000. So applicants are debtors for 25,000. Debtor is an asset. Asset shows a debit balance. Therefore, applicants' names we have to debit. Instead of writing applicants' names, we write share allotment account. Share allotment account debtor. From applicants, how much money should come? 25,000 rupees. In this 25,000, 15,000 actual allotment money we are transferring to share capital account. Then the remaining 10,000 is what? This is share premium amount. On one share 2 rupees, on 5,000 shares we are collecting premium now. 5,000 into 2 rupees, 10,000. This 10,000 we have to show with a separate account name. That is share premium account. So for 10,000 we have to write to share premium account. Why share premium account is created? Share premium is a gain to the company. Gains come under nominal account. No? Expenses, losses, incomes, gains come under nominal account. Nominal account rule, debit all expenses and losses, credit all incomes and gains. This is gain to the company. That is why share premium account is created. So as per nominal account, we are crediting share premium account. So remember, share premium account is showing a credit balance of 10,000 rupees. Incomes are of two types now. Revenue income, capital income. Revenue income means regular income, repeated income, recurring income. Capital income means non-recurring in nature, rare income. Share premium income is a rare income. So this is a capital income. So for what purpose company can use this 10,000 rupees? So regarding the usage of share premium, there are some rules which are prescribed by Companies Act 2013. Let us see those rules. As per Companies Act 2013, company can utilize this securities premium money for this purpose. First one, to issue fully paid bonus shares to equity shareholders of the company, company can utilize this share premium money. Second, to write off preliminary expenses of the company. Third, to write off the expenses of or the commission paid or discount allowed on any issue of shares or debentures of the company. 4. To pay premium on the redemption of preference shares or debentures of the company. 5th, to buy back company's own shares or other specified securities. 6th, to pay premium on buyback shares. 7. To give bonus shares to creditors instead of paying money to them. 8. To write off any deferred revenue expenditure such as heavy advertisement expenses, development expenses, etc. So company is not permitted to utilize this share premium money for any purpose other than the points mentioned here. If premium money is utilized for any other purpose, it is treated as reduction in the capital, which is not permitted as per Companies Act 2013. Second entry, share allotment account debtor to share capital account to share premium account. Share allotment account 25,000, share capital 15,000, share premium 10,000. Narration. So for what we are writing this entry? Share allotment amount 25,000 we received. From this to share capital 15,000 we are transferring. How 15,000 is coming? 5,000 shares at the rate of 3 rupees each. And remaining amount 10,000 we are transferring to share premium account. How 10,000 is coming? 5,000 shares at the rate of 2 rupees each. Mention that in the narration. Being share allotment money on 5,000 shares at 3 rupees per share is transferred to share capital account, and premium money on 5,000 shares at 2 rupees per share is transferred to share premium account. Third entry is for first call transfer entry. To transfer application amount to share capital, this is the entry, no? In the same manner, we have to write here also. Instead of share application account, write share first call account. Share first call account debtor to share capital account. How much amount should come? First call. On 5,000 shares at the rate of 3 rupees each, 15,000 should come. Write that amount here. 15,000. Third entry, share first call account debtor to share capital account. Narration. On 5,000 shares at the rate of 3 rupees each, first call amount 15,000 we are transferring to share capital account now. Mention that. Being share first call money on 5,000 shares at 3 rupees per share is transferred to share capital account. Fourth entry is for transferring final call amount to share capital account. Like third entry, share final call account should be debited. Share final call account debtor to share capital account. 5,000 shares at the rate of 2 rupees each, 10,000 should come now. Write that amount here, 10,000. This is the last entry, fourth one. Share final call account debtor to share capital account. Narration. 5,000 shares at the rate of 2 rupees each is the final call money, 10,000. That amount we are transferring to share capital. For that we are writing this entry now. Mention that in the narration. Being share final call money on 5,000 shares at 2 rupees per share is transferred to share capital account. Take a screenshot of journal. Cash book, journal, both are completed. Finally, balance sheet. Let us see how to prepare the balance sheet. This is company's balance sheet. Heading, balance sheet of Amar Limited as at dash. Liabilities amount, assets amount. Categories of capital, under the head share capital we should show. First one, authorized capital. In question, authorized capital related information is not given now. Therefore, authorized capital is nil. Issued capital. Company issued 5,000 shares at the rate of 10 rupees each. Therefore, issued capital is 5,000 into 10 rupees, 50,000. You may get one doubt. Company issued shares at a premium now. So 10 rupees is the par value, but issue price is 12 rupees. Then why we are not multiplying 5,000 with 12? Because the 2 rupees extra premium money separately we have to show. we should not include that in capital amount. That is why only capital details we are showing here under the head issued capital. Subscribed capital. Public applied for 5,000 shares and company allotted 5,000 shares to them. Therefore, subscribed capital is also same. 5,000 shares at the rate of 10 rupees each, 50,000. Next, called up and paid up capital. Called up capital. Company made all calls now. Application money, allotment money, first call money, final call money. In current year only company made. Therefore, called up capital is also same, 50,000. 5,000 shares at the rate of 10 rupees each. But paid up capital is not 50,000 because calls in arrear is there. On first call, at the rate of 3 rupees on 1,000 shares, there is a calls in arrear of 3,000. On final call, at the rate of 3 rupees per share, on 1,500 shares, there is a calls in arrears amount of 3,000. So 3,000 plus 3,000, total calls in arrear amount is 6,000. From 50,000, subtract this calls in arrears amount, 6,000. So in outer column, finally paid up capital is 44,000 rupees. So for totaling purpose, we should not consider issued capital, subscribed capital and called up capital. So we should consider only paid up capital. That is why paid up capital we wrote in outer column. Next come to share premium credit balance, 10,000. As per section 52 of Companies Act 2013, share premium credit balance we have to show in balance sheet. On liability side, under the head reserves and surplus, we have to show that. So liability side total is 44,000 plus 10,000, 54,000. And asset side, we prepared cash book now. In cash book, balance carried down is 54,000. That amount we have to show as cash at bank. Totals, two sides same, 54,000, 54,000. So this is balance sheet. Take a screenshot of balance sheet. This is the end of present video. Hope this video is helpful to you. Thank you.